I'm Clark McGinn. I work for my own company called Uplifting Advice, which gives uplifting advice to people who are down in mouth generally in our industry. And let me introduce our panel. We'll just start with Ed and ask everybody to introduce themselves very quickly.
I've already been up here, so I'm yes.
Oh, you were that guy. That's it. Okay, Olivier.
Good afternoon, everybody. Olivier Piot, I'm CEO of Nova Capital. Lessor, I'm afraid.
Great. Good afternoon, everyone. It's Jaspal from CFO from LCI.
Russell Christopher, Managing Director of Thora Capital.
Mirika Nakayama from ITC-AeroLeasing.
Okay, well, ladies and gentlemen, let's start straight in with the first question. I think this one's probably more for Olivier and Jaspal to kick off. Where are you guys finding funding in 2019? Who'd like to start?
We have been reasonably successful in 2019 by sourcing new funding. We are definitely a member of the second category of lessor that I think that you described yesterday, meaning people with having a balance sheet whereby you just, if you have a good deal, you pass through your own in-house process. And the second category being, I would say, high and just most probably too, where we have to source money. So in 2019, we were able to source both debt and additional equity to fund new deliveries. So just to give you some idea, we have done on the debt side 3 different facilities with 4 different banks. The interesting point maybe was that 3 of them were new to us. So that's I think an interesting clue of some banks being in the market for helicopter. And we raised some equity on an ongoing basis with our usual equity partner on the new deliveries we have.
Great. So I'll just break it down into 2, which is the debt and then the equity side. On the debt side, LCI as a house raised, financed and refinanced over $400 million last year, which is quite an achievement. And that kind of decomposes amongst banks, non-bank debt. We'll talk about that later because the bank markets are still a little bit dislocated. So that's the debt side of the house. And then on the equity side, we have been raising equity for managed vehicles. I think the equity appetite at a private equity level, at a platform play, is relatively limited. So that's not really been available for many people, if any. So we've raised significant sums on both sides of the house, Clark.
Good. That's slightly more encouraging than many people have been sort of saying today. And maybe it's just because you 2 guys have either a good balance sheet or a very persuasive pitch book.
No, I just borrowed it from him. He borrowed it from me. So we're just recycling the money.
And on just picking up on that, Russ, where are you looking to deploy funds as an investor?
Well, we in this fragmented market as it is, we need to be highly selective, of course. And the banks were speaking about this earlier. We review deals on a credit basis and looking at the assets much the same way the banks do. Probably the only key difference is banks tend to be backward-looking at historical performance, and we can take a more selective view of what we think the future performance is going to be, and look at how we think an operator is going to mature or take advantage of what we think is an emerging niche, and be a little more selective on that basis.
That's interesting. Can you give us some sort of examples there, Russ, of what the niches you find interesting?
Well, I suppose they're probably not niches to anyone in this room, but we're talking about EMS, utility, obviously the encouraging development of the offshore wind market. I've been looking at military-backed deals where we're dealing with a commercial operator but with a military contract. We quite like that. We like the long-term utility contracts with larger networks, especially in North America, this kind of thing. Long-term commercial applications, firefighting.
And Mirika, do you want to tell us a bit, because you've obviously got a very different kind of funding and investing model. Will you tell us a bit about that, please?
Yeah, so we actually go quite opposite of probably other leasing company in the sense that we're 100% equity. So know that.
Okay. That's a very simple model. Well done. In terms of those, moving rapidly on to the next question, in terms of those niches, Jaspal, Ed, Olivier, that Russ was talking about, does that chime with your experience, the areas that people are looking at or responsive to?
I think Russ basically was almost saying anything other than offshore. You know, the fact that he's looking at government stuff, I think, is just quite interesting. That's probably pretty off the run for most. But, you know, as an investor, I suppose, an investor that was sort of looking to play the cycle, I mean, you're going to see that interest in offshore. And if you look at, you know, Bristow PHI as an example, you know, the current owners, these were bondholders or hedge funds that became, you know, bondholders because they saw that was the opportunity. And I think my guess is a lot of their analysis was focused on the asset level. You know, what is this company worth? And you know, that's where they're going to try to play. It may be that the lenders don't want to support that market, but again, it's interesting that you know, for the deals that people seem to want to do are the ones that you guys are all doing. So, and I guess it's good maybe for those operators that there's sort of competition, but I think there's still an opportunity around oil and gas assets, even if people aren't really prepared to invest in them the same way.
I totally agree. So rather than sectors, I think Russ and Ed has said it all. Maybe we'll do it by type, which is in a very dislocated market. You have to park the whole idea of residuals just for a while. I mean, it stops becoming a balance sheet issue. We'll worry about residual when the market turns or at some point in the future. Right now, let's flip to P&L. So you're underwriting a credit. This is the key. And I think Russ, the source code that Russ was trying to say is, I'm now writing a lessee. This is what I'm leaning on. Unfortunately, at exactly the same time, we've had stress in the lessee. So this is the double whammy.
Yeah.
So rather than sectors, which I agree just totally with everything that's we're trying to underwrite the best lessees and commercial deals we can.
We have every intention of doing deals in the oil and gas sector, but we just want to have some confidence that we'll have cash flow for a certain minimum period of time, and that's not very easy to do in that sector at the moment.
Olivier?
Yes, for us, not surprisingly, as it is our strategy from the inception of Nova Capital, we are onshore and with a strong backbone on the EMS. But as I do agree that I don't think there is any forbidden sector or a good sector or not a good sector. There are only good deals and bad deals, right? So I suspect we would not refrain to go on another onshore sector if we can have the adequate funding to meet the customer expectation and the market and the revenue we want to have from those assets. And I'm jumping maybe on another issue, but there is not neither bad helicopters or good helicopters. You know, especially we talk about new ones and used. I have to confess that we have done good deals with used helicopter. It's all about the way you can fund it for us, which would be significantly different. But yes, that's it. And firefighting is one of our target at the moment.
I think there's a very pragmatic approach in what is a difficult market. But you say good deals, bad deals. Have you had to change any of the structure of your deals to make it more appealing to the banks? Have there been any major differences you've noticed in the last couple of years? Anyone?
Not really. We were focusing on our the new money we invest, where we are, as you said, we consider first of all the credit risk, and we give a high value of having a reliable customer and a long-term lease with the assets we are feeling comfortable. So that's the way we are, at least on the first lease period of these assets, as all of us have to manage some transitions or lease extensions, etc. But no, I mean the new money we are focusing on long-term contract with reliable assets and customers, of course.
Jazz?
Yeah. Also, I mean, we're focusing here on being active, but at some point, particularly in a down market, you've got to be rather tactical as well, which is, we'd love to do the best deals we could all day long, but let's flip that slightly and say, what do the banks want, for example, or what do the investors want? And that forces a chain reaction in you. So they would like now full PBH. They would like assignment of the PBH. They'd like US dollars. They'd like a long term. So we haven't changed our strategy per se, but we have been forced to change certain structural parts of our deal in feedback to what we're hearing in the market. So it's a bit of give and take.
And you're managing to balance that off against your underlying lessees requirements as well.
Yes, yeah, exactly. Yeah, so you're trying to triangulate basically to get the answer. Yes.
Good. Okay. An important part of that here that Olivier said he's got no good assets, no bad assets. Yeah, there's a lot of discussion about valuations. Yeah, how much is that impacting any of you? We've had a couple with Sarah, and we had early values yesterday, Sharon. How is the valuation theology impacting your businesses?
I'm gonna, if I can, just start with it. Just look, having been out in the market for new equity and sort of with people looking at particular assets, like I don't think the equity investors, at least, care about the appraisals at all. Like I think it's especially if they've got experience in the asset class. So very much be focused on what could I actually sell these things for. And I think I go back to the Bristow PHI example. A lot of those investors that were coming into that space were, I don't think they cared about the appraisals either. It was, if I have 25 S92s, what can I sell them for? If I have to sell them, what's going to be the price at which they clear? So it may be that the lenders sort of look at it a little bit differently, but equity investors at least were, looking at the real world valuation.
Possibly. I might just see it slightly differently. On a new equity, let's just talk about equity for a second. On a new equity play, you need to hang your hat on something if you've never been in the sector. You're either going to rely on an advisor or some press reports, or you've heard about Waypoint or whatever it is. There was a chart this morning from Cirium showing EC225 and S92 values. And in fact, that was just apocalyptic if you were a brand new equity and you saw that. So yeah, you need some construct. I'm riding equity into a platform. What's it worth in 5 years, 10 years? So you need something. I don't know if the appraisers are the answer or not. On the debt side, I think we've had an even bigger dislocation.
Right.
Because a bank credit committee really needs to hang its hat on something. And at that point, you really need to stress the appraisers. And the question is such a oft-asked question, I don't know how to answer it, is what's the scatter? What's the data point? How many trades are you seeing? Can I actually see the data points? Can I see some back testing? So show me the forecast you made 10 years ago and how you tracked to it. This is a big problem, and I just don't know how to solve this, because in the fixed wing, or rail stock, or container boxes, or shipping is even the most extreme example, you've got so much data and it's so transparent. You could go into Bloomberg this afternoon and track individual charters for ships with the rate. Nothing's more transparent than that. And we are in a niche of a niche. So I think in certain applications you've got to hang your hat on something, and unfortunately in certain areas it's appraisers.
Mirika?
I think because we're financed 100% equity, we do not have this concept of also like LTV. We always go with 100% finance. There's, Jaspal rightfully mentioned about, how do you see the appraisal, whether it's right or not, And so we work closely with the appraisal company as well, but I think everyone knows, Aero Asset. the gentleman from our asset, I think everyone knows, but we have a very good long-standing relationship with them. And also our team are constantly trying to validate the appraisal value by ourselves through our, because our portfolio started the season, so we see a lot of secondary transaction that we have to take care ourselves. So this market being challenging also allow us to learn a lot about the market and how the market transaction, there's a time lag until it gets reflected to the appraisal report, which was a very interesting experience. It wasn't necessarily always a happy ending, but it allowed us to become much stronger for the future deals.
Yeah, that makes a lot of sense. And Russ, how do formal valuations fit into your model?
Well, they don't determine our investment strategy. We look at a deal on a deal-by-deal basis. We look at the liquidity of the asset type. We look at the strength of the counterparty, and we put our own value on it and what we're willing to risk for what we think we're going to get as a reward. And then we will seek appraisals, and if the appraisals support our own view, then we'll move forward. But we don't rely on them beyond that.
Mirika.
Also, when you do appraisal, sometimes you do appraisal based on a particular configuration, right? But in the course of our portfolio seasoning and replacing it or remarketing it, we have worked on changing the configuration, and also sometimes the exit strategy is not just selling, but converting that into a financing lease or some sort of long-term lease. So I think whilst appraisal is very important, I think there's a lot of application, and how to interpret it and how to use those data, for your advantage, I think.
And just, Olivier, just taking that point, you said you'd introduced 3 new banks to Nova last year. Yeah, how do you bring them through that education process?
I'm not sure they needed me for this education process at the early stage, but I would be maybe the one, maybe a little bit defending the appraisers here, as the job they are doing is really helpful indeed, and it will be, I guess, a little bit too easy for us as a lessor to say, oh, this asset doesn't value what you told me 3-4 years ago, and blame them for that. I think that the very first criteria for us is how much this asset, what the revenues of this asset will generate for my customer, and so being able to repay or rentals, and how much this asset will generate revenues in the future. You have to find a new home for it. I think that the appraiser job is really helping in terms of, you mentioned the advance rate of our loan. Of course, this is a reference, and it's more and more accurate in terms of having your optionals being taken into account, etc. It's not perfect, but at least it's helpful to show new banks in the market, or to have a trend and show what is the history, what was assumption for same kind of assets 10 years ago or 5 years ago. It's only one element in the analysis, but I think the revenue generating criteria is definitely the most important for us.
Yeah, again, I think it bifurcates. I mean, Clark, you're the ex-banker, you should tell us, but it bifurcates really, which is existing banks who know the sector and know you and know helicopters. That's a different story. But maybe it's illustrative to walk through a brand new bank. I'll do it very quickly without getting too technical. You're fundamentally, as a bank, trying to do 2 things, which is try to work out the probability of default and then the loss given default. And you can attack those then, because that will determine how much reserves you have to hold against that loan. So the probability, you're talking about credit, and you're talking about ratings, and there's a lessor in the middle, and do I have recourse, and there's the whole credit spectrum. So there's a 10% chance this deal blows up on me in 3 years or whatever it is. And then you've got the loss given default, which is I may get back a 139 in 3 years, to use my example. Can I sell it? Well, what's it worth? That debate has become more nuanced because we're now having to explain power by the hour programs to banks, because they realize the plus minus from full life to zero life on a helicopter is actually quite large relative to asset value. So you have to start talking about taps and paps and schnaps and craps and whatever they are, to explain, listen, if you've got a fully paid up program and it's with the manufacturer and you have an assignment and it's in dollars and da-da-da-da-da. So to a new bank, these are the discussions you're having. That's how you bring them in. That's how they get comfortable. That's how they get signed off on the credit committee, and then off we go.
It's the classic old banker's rule of what's your secondary source of repayment if the first one doesn't work. Yeah, Mirika.
I just want to clarify. I fully agree with Olivier. I do have utmost respect to all the appraisal company. I think the industry needs somebody to monitor like where the value is. But if I just want to make sure that because I relayed my comments correctly, is that I think it's very important to understand what it means and how to understand it. Not just to say, okay, just simply because appraisal value says this, that's it. There could be some transaction that popped up which was unique, and then what I'm saying is that the appraisal value is something. It's a starting point, and it's not just the ending point. Thinking that I got the appraisal value, so that's it. I think it's very important to trying to really sound the market yourself, and trying to measure the risk that you're entering into.
Yeah, that's very fair, isn't it? The appraisal isn't an offer from Sharon to actually buy the helicopter at that price, unless you'd like to branch out into that business. No, maybe not. Okay, let's just pause here, guys. We've got a question that Joe Hawk has sent us. In terms of the double whammy, aren't they co-implicated? That's a good word, co-implicated. In other words, aren't asset values and P&Ls the byproduct of demand in the first instance, plus or minus? Ed?
Yeah, look, certainly in oil and gas downturn, yes, has hit P&Ls and asset values, but I think in many cases that might not necessarily be the case. Pick an aircraft that can sort of cross sector, so the company that's buying it, if it's not in the oil and gas business, its P&L isn't going to be implicated at all. So in that case, it just takes advantage of the sort of cheaper asset value. I don't know if I'm quite answering Joe's question wherever he might be, but that's my... Yeah, I don't...
Well, all I'm trying to say is, what is the single whammy?
Oh, the single whammy.
The virtuous circle that took it all up and created the bubble.
Yep.
Inevitably becomes the double whammy on the way down.
Yeah, and I don't mean to be the outlier here and say, oh, it wasn't a bubble, but let's recognize that things were going well until
it went bad.
No, but basically until Saudi Arabia sort of turned on the taps, right? So if that hadn't happened, would we still be in a bubble, or would we just be in an environment where there was a lot of demand that was driven by high oil prices, which encouraged drilling? I guess, to me, a bubble is like tulip mania, where everybody thinks the price can't go down. I think in the oil and gas industry, there was a fundamental change in demand. It wasn't that we were all imagining demand was there that wasn't. This was based on expectations of what oil companies were going to be doing, which was, again, based on how people were consuming oil, blah, 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 blah. So I'm not saying there wasn't a lot of over-enthusiasm and people thinking they're both going to win the contract, and going back to Mike's example with, the jeweler and the, and the 10 people looking at the same ring. But a lot of that enthusiasm was driven by the fact that oil companies were spending money to find oil that we as a society wanted to consume. And when oil prices were high, they did more drilling, right?
I'm not debating whether or not the demand was valid and existed at the moment that everyone was, taking all the orders and putting out, new S-92s on lease and all of that kind of stuff. I'm just saying that in the downturn, I don't really see how you could have just the balance sheet impact without a, to use my term, co-implicated P&L impact, because after all, the reason asset values went down was because of a essentially falling off a cliff of the demand for the supply and the service in the first instance. If you don't have a need for the asset, there's going to be a bunch of excess stuff. It's supply and demand, and by definition, once the demand goes down, so too does the revenue, which means the P&L is going to be affected.
And I'll be taking that up.
I'd be curious to see, like, to hear counterexamples of how they get decoupled.
Yep.
That aren't unique to a single.
Yes, you were the.
And this is something I'm going to talk about.
I think that's right in certain circumstances, which is if you're. One of my friendly suggestions to Al later is going to be, we've focused relatively a lot on oil and gas in this conference, but that's a separate issue. If we're talking oil and gas, and if you're a large operator who's relatively monoline to oil and gas, yes, everything's going to move in tandem. There's a very high beta, because at the same time oil falls, they're going to have Chapter 11s and the asset values are going to fall. If we just paint a slightly broader picture, which is maybe on the EMS or search and rescue side, you have some very interesting, sometimes smaller operators who have a better credit rating than some of the larger ones because they are backed by a contract that is absolutely first rate. So in oil and gas, I would agree with you. There's a very high degree, and there was a very high degree of correlation, but in other sectors that may not be the case. And
if I could jump in, just looking at my experience at the global financial crisis when I was running RBS's Rotary book, their asset price fell, but the P&Ls didn't fall on the operating companies. The asset prices fell because there was no money to transact and keep the asset market flowing. So the asset market froze, but the operating market maintained. So you can have a single whammy, I think. But any other thoughts on this? Olivier is saying he's wanting to speak in French.
I'm not sure I'm the
Mirika?
most qualified.
I actually don't understand the English.
Okay.
Yeah, but no. So seriously, I don't understand. But
you want Joe to ask in Japanese?
If the part that the P&L, like at least like I think in certain area you have age limitation, right, to operate. But in certain sector that they don't have age limitation, when we speak to the lessee's CEO or CFO, they constantly think about what is this aircraft brings on to their table as a P&L. Am I answering correctly? Like I think if this is a question talking about how should aircraft be valued, I think originally it was supposed to be valued by the revenue because this is just a tool for them to make money, right?
Yeah. So that theory would be they were linked. Yeah, sure.
Yeah.
Yep. Okay.
Yeah. So I mean that's kind of the point, right? Like helicopters aren't an end in themselves.
Okay, can we talk about this in a minute, Joe? Because we're just turning into just a wee bit of a dialogue there, and that's what I'm here for, to keep talking instead. But moving rapidly on, in terms of what you're finding on the equity side, guys, can we talk just a bit about the sources of equity that are coming in that aren't distressed bondholders converting? And we can talk about them too if you'd like.
I could give some thoughts. As I said earlier, the platform level plays of 2011, 12, 13 have kind of played out for the moment. One could make an argument that there's a dislocated market. It's a great time to come in at a PE level. What we've seen is more of a demand at a transaction level, certainly. So groups of assets, I'm an investor, I just want a certain IRR over a certain term. I don't need to worry about teams and platforms and brands and websites and all the rest of it. So we've seen that. So if you went through the entire universe, I guess you could start sort of super hedge fund over here. I mean, if you want money for 60 days, I'm sure somebody's going to lend it to you. Institutional capital, private equity, your family offices, pension funds. I mean, there's something everywhere. I think at a platform level, it is compromised.
Can I just maybe comment on that? Like, look, I mean, this is, if I go back to the Waypoint process, so look, I was gone, right? But before Waypoint filed for bankruptcy, they went through a process where they met with a lot of investors. They ultimately took their deal with Macquarie. So what I know is just kind of what I've heard. I have, but not part of the process. I don't have confidential information that I know about. So I'm just going to sort of chat with what I've heard. But if you look at the groups that bid for that platform, from guys like Thora to some of the large institutions that are PE firms and whatever else. And some of those guys may have been in the process because they were more interested in Bristol or PHI, but they were kind of doing their research. Others, might have been sort of quite serious. I guess I would characterize that group as really, large asset managers. I don't want to say alternative asset managers, but in some cases they were hedge funds. But these were all this is where their special situations group comes in. Post Waypoint, when I started managing one group of assets for a lender group, I then went out and met with a bunch of potential investors to sort of see, was there someone who would sort of support that? Some of those same folks from the Waypoint process looked at it, but I'd say the most interest came from hedge funds or maybe larger institutions, but those that would sort of fit, again, their sort of special situations are going to sort of play in what is a distressed asset. So that's, again, just my own experience of where I sort of saw the interest. Russell and Jazz are sort of looking for different kinds of equity investors, and I think, the fact that LCI's done its managed vehicle, and obviously Russ has gotten his group up and running, like there's interest there in the asset class.
If I just make a comment on this, Jazz is perfectly right, and maybe I would add on your list some subordinated debt fund, which are at the moment, I suspect, interested by bringing us some kind of in-between tranche in this. But let's say the two main comments I would like to make is, first, it's very important that you have a long-term relationship with your equity provider, whether you had one or several, as you mentioned in your previous speech, because this is a long-term investment in a long-term industry. But most importantly, I think that the most important mistake we should not make again is to be under pressure to invest equity or invest money. This is not a race. And definitely, if you are under pressure because you have money which is committed and you need to put it at work, is that the correct expression? Yep. I don't know. It brings you to a situation whereby maybe your criteria list will be not in the same order anymore. And I think that the question is there equity or other source of funding available for helicopter? Definitely, I would say yes, and we had on the other panels the demonstration of that. But we should not be under pressure to doing transaction for having the equity or whatever the funding being utilized.
Yep, Mirika?
This is more like question to Clark, but I'm very keen to understand about that myself. So I should rather be sitting there. I think when you say debt, there are so many different type of debt, right? And I was absolutely impressed when I had a coffee chat with Olivier that he managed to get non-recourse debt. That's like amazing, so if he could elaborate a bit more on that.
This is maybe the differentiation point on our model and the funding is that 100% of our debt is basically asset-backed. So that means that it is back-to-back with our lease term, back-to-back with the condition of our lease, and it has several, I think, advantages. The first one is that when you have such a debt, you cannot play with the residual value cell on your Excel spreadsheet until the end. Because basically, if the revenues, once again, what you said, the revenues coming from the helicopter doesn't pay for the rentals, and the rentals doesn't pay for the whatever debt service, it could be debt, sub-debt. We can all be able to design very complex things, but if you don't have enough money to serve that repayment, basically when you are on a non-limited recourse or asset-backed deal, the bank or whatever it is will not lend you the money. So it's not possible. So it prevents you sometimes to go too far on your residual analysis. And I would say, and then I will stop, that this model also helps you to, I heard some of the lender in the previous panel saying that they like to have an equity buffer in front of them to have the management capability of the lessor. That's right, but in this model, it's also solved the issue of, am I able to take my asset back quickly and easily? Yes, because this is an asset-backed financing and it's not mixed into a more global portfolio.
And one, if I could just jump in, please, Jazz. Yeah, we've just been asked an anonymous question, so that's always suspicious in my book. But Olivier, do your customers have termination rights? How much notice do they give you? Can you answer that, even broadly?
Hopefully not that I am aware, but if you said if customer means the lessee,
yeah.
Yes, we have fixed, as everybody in this stage. I suspect we have long-term commitments. It could happen in certain circumstances, especially to be back-to-back for our customer to be back-to-back with their own.
Contract.
Let's Medivac contract, for example, that could have an early termination option, but of course this is not for free. And this is a price, and you have to reprice your deal as if this would be exercised and be comfortable with the residual, etc. So that's happened. But if it's purchase option, no.
Yes. Can I just make one suggestion and comment on the previous point? What the suggestion is, I think Ed said it perfectly. The equity we see is the equity we see. That's reality. But what we would like to see is something completely different. We have to, we really have to get out of this kind of short-termism mode. If you're chasing short-term equity, short-term returns, that's going to drive certain incentives. We've got to get into the long-term patient capital. Talk about 30 years, whatever it was I heard yesterday. That's point one. I mean, let's be frank and hold a mirror to ourselves just for a second. How many real long-term patient investors have come to this conference? There's virtually none. We're talking to each other. Number one. Number two is, it doesn't matter what type of equity, let's just call it X. It could be private equity, it could be whatever. It's still going to ask a version of the same question, which is, how do I get my returns? And that equation has three parts, which is, and it doesn't really matter if you do an IRR at a helicopter level or a DCF at a corporate level, which is your day one economics, your lease, and then your terminal. You can play around with those three. Generally, you want to buy right. It's nice to have the other two. And then you're going to butt up to the same problem, and maybe we'll talk about this later, which is the economics of the business. Which is lease rates relative to asset value. And if anyone can answer that question, I'll be very interested to hear it. Because we are just not getting, for ourselves, let alone equity investors, the risk-adjusted returns we need to on a cash flow basis. I'm excluding day one and residual just for a second. So those are my 2 points to that.
Anyone want to add into that? We've just got a couple of minutes. Mirika?
I think I want Russell to speak a bit more. Because I think, I mean, I don't know how much of trading secret he wants to disclose, but talking to him is quite fascinating. I think he does not go for scale, but he goes for return.
Well, before he jumps in, can I just challenge
strange concept.
That's the best $50 you slip.
I want him to talk a bit more, because I think he has a lot of interesting talk. No?
I'm flattered. What would you like to talk about? Can you elaborate?
No, your debt and equity, how you finance,
Well, so we're a little different to these guys. We're not a balance sheet finance company like LCI and like Olivier. We in fact don't have a balance sheet. We manage committed capital from institutions and family offices. And we're a fund manager, so every deal we do is structured differently, quite honestly. Clearly, the more we can leverage a deal with debt, the higher we can boost our return to a point. Like we were talking about earlier, we still want to deploy meaningful amounts of capital, so we don't want to leverage it to the max. So there's a crossover point between how much you leverage versus how much capital you want working, as long as you meet the hurdle. We've been doing deals in North America where we're sourcing debt ourselves from banks that haven't been in the space for a while or never. But also we're bringing in institutional investors and family offices that have never done aircraft before. So what we're trying to do is create sort of a secondary market, liquid secondary market of investors that we can deploy their capital, manage it, and actually sell deals back to them, because we are hopefully about to sell a deal soon that we closed only several months ago, which, you know, we are a long-term investor, but it helps us to be able to demonstrate liquidity in that way to raise more money and be more useful to you guys. But on the debt, you know, it's very difficult at the moment to, unless you're dealing with, you know, out of the thousands of operators, unless you're dealing with the sort of top 20 or 30 that actually have a financeable balance sheet or credit, you are basically scratching around for debt. It's really difficult.
That's why I find it very interesting. Sorry.
No, I just wanted to challenge Jazz's point just a bit, but from before, look, and I don't mean to sort of sound flip, because I'm certainly at Waypoint, you know, well familiar with needing to keep aircraft on lease, and you covenants, and, you know, some money's better than no money, but, you know, when you say you're not getting the return, or the rent is not where you want it to be, sell the aircraft. Like, no one in this business has to put the aircraft out on lease. Like, if you can't, and I think you're seeing this with some of the, let's call it, you know, the guys that don't need to worry about banks, they can afford to say, you pay my price or not. You know, the aircraft will sit parked. And certainly, you know, operators can be in the same position. If you don't pay my price, I'm not going to fly for, you know, oil company X. And ultimately, you know, that raises prices. But, you know, if you're putting capital to work, you're going to accept the lease rates that you could get and maybe hope that they kind of get better. But I don't know, I just feel like, you know, there's no one that's forcing you or anybody else, right, to be in the business. The lease rates aren't there, sell the assets, you know, go back to fixed wing, rail, whatever.
Let me address that. So you've got two things there. One is on the new build. Would you do a speculative new build? You go into an asset that you didn't have to, knowing what you already know? Probably no. If you looked at the lessor order cycle, it's essentially come down to zero. If you're already in the asset, and I think the nuance you should add to your analysis is, in a static game, yeah, fine, just go sell the asset if you can't make the return. This is a dynamic game, i.e. the person on the other side is also trying to assess whether he or she or it can lease the asset too. And generally in life, but certainly in markets, you have arbitrage, and that smooths out everything, i.e. the price they will pay is also reflective of their view of what they can lease it for. So take the pain now, take it later, take it over time. It's not just a simple, I can't get the lease rate, I need to sell it. It's slightly more nuanced than that, I think.
Okay. Well, I think that's on a point of fine nuance, so we've just about run out of time. So can I say thank you to Ed, Jaspal, Mirika, Oliver and Russ. I think the message we're getting here is it's a hard market in financing, just as it is in operating in almost every part of our helicopter business. But by triangulating, to steal the words from Jazz, you can possibly find something. It just takes a bit of effort. So thank you everybody for making the effort to come out here today. And that concludes this part of the show.